Assalamualaikum and very good day to our lecturer, Puan Fatin Alia Zahri and my fellow classmate. We are from Group 7 and today we will presenting our assignment titled Accounting for Sukuk for the Islamic Accounting Practice course. For next slide, I want to allow me to introduce my group member first. First, I am Ali Furkan and my fellow members are Amirul Haziq, Azim Azrai, Ahmad Naim, Hafizuddin and Haziq Syahmi. For next slide, about presentation overview. Uh, First, I will walk you through about the introduction and the core nature and definition of suku. After that, my teammate will explain the MASB framework and the specific accounting treatment covering the recognition, measurement, and journal entries. Finally, we will wrap up with the reporting section, which include presentation requirement, practice example, and our recommendation. Continue to my part. Let's start with the core question. What is sukuk? According to AA or IFI, sukuk refer to a certificate of equal value representing undivided share in the ownership of tangible asset or service. To fully understand sukuk, we can compare it directly to conventional bond. A conventional bond is fundamentally a debt obligation based on the lender-borrower relationship. It involves fixed interest payment, which is riba, and it is not necessarily backed by any physical asset. On, an, on the other hand, sukuk represent an actual ownership state. It is strictly asset-backed or asset-based. Because of this ownership structure, it involves profit and loss sharing, where the returns are generated directly from the underlying asset. Most importantly, sukuk is strictly Sharia compliant, meaning it explicitly prohibits riba, interest, gharar, uncertainty, and martial gambling. So I want to pass to next person to continue for introduction. Thank you.
To start off our main topic, let's look at the introduction of sukuk in the modern market. Sukuk has successfully transitioned from a niche market into a highly sophisticated global financial industry. What sets apart are its share-derived ethical principles which strictly distinguish it from conventional bond by prohibiting riba, interest, and gharar, uncertainty. The framework strictly mandates risk share and requires tangible asset backing. Therefore, sukuk represent undivided proportional ownership share in this underlying intangible asset rather than just a simple debt obligation. Now, let's look at a major financial reporting challenge. How do we account for sukuk? Sukuk is a unique hybrid instrument because it blends the characteristic of equity, such as the ownership of asset with the behavioral pattern of debt, like providing regular income streams. To solve this, the Malaysian Accounting Standard Board (MASB), which is the independent authority under the Financial Reporting Act 1997, sets the standard. MASB used dual compliance strategy that aims for IFRS alignment with upholding Sharia principle. The core strategy relies primarily on economic substance over legal form, heavily utilized MFRS 9 financial instrument to classify sukuk based on cash flow and measure them based on business models. To give you a clear roadmap, here are the scope and objective of our group presentation. We have broken our analysis down into 4 key areas. First, natural and definition, where we will deconstruct the legal, economic, and structural definition of sukuk versus conventional debt instrument. Second, the recognition and journal entries, outlining initial and subsequent criteria with practical accounting entries for both issuer and investor across the timeline. Third, we will evaluate the measurement framework, providing a critical evaluation of amortized cost versus fair value under MFRS 9. Finally, the presentation of the and disclosure, where we will review Islamic financial institution IFI requirement and look at real-world financial statement analysis.
My name is Muhammad Haji Syahmi bin Nurisam. Now, I will be present the accounting recognition framework for sukuk under MFRS 9 financial instrument. According to MFRS 9, an entity recognizes a sukuk instrument in its statement of financial position only when it becomes a party to the conceptual provision of the instrument, this must be evaluated from two distinct dimensions. First, the issuer perspective. The classification depends on the economic substance of the contract. It is recognized as a financial liability if the issuer has an unconditional obligation to deliver cash, such as fixed periodic distribution and a compulsory buyback at monetary. It is recognized as equity if the profit distributed and non-cumulative and fully discretion, like in a perpetual mudarabah sukuk. Second, the investor perspective. The investor recognizes the sukuk as a financial asset on the trade date. Classification depends on the entity business model and the SPP test. They categorize the sukuk into either amortized cost, fair value to other comprehensive income, and fair value to profit or loss. Finally, before apply MFRS 9, the initial asset transfer must pass MFRS 15 in typical Malaysian sukuk ijarah. This transfer failed the MFRS 15 sales criteria because the issuer retained effective control and risk. Therefore, it is treated strictly as a secure financial arrangement. Now, let us look at the practical application through the sukuk ijarah case study. Our parameter assume a nominal value of 100 million ringgit and annual profit rate of 5% or 5 million ringgit and a tenure of 5 years. Because the taxation failed the MFRS 15 sales criteria, the journal entry are recorded as follows. From the originator perspective, at initial recognition, the originator record the cash injection and the financial liability by debiting cash for 100 million ringgit and crediting sukuk financial liability for 100 million ringgit. For subsequent measurement, the annual rental distribution is recognized as a finance cost by debiting finance cost for 5 million ringgit and crediting cash for 5 million ringgit. From the investor perspective, at initial recognition, the investor record the investment is asset by debiting sukuk investment asset for 100 million ringgit and crediting cash for 100 million ringgit. For subsequent measurement, the received return is recorded as income by debiting cash for 5 million ringgit and crediting profit income for 5 million ringgit.
Alright, Assalamualaikum warahmatullahi wabarakatuh. My name is Ahmad Naim bin Ali. So, let's begin with the measurement of sukuk under MFRS 9, which relies on two gateways. First, the business model test checks if the sukuk is held to collect cash flows, held to collect and sell, or held for trading. Second, the SPPI test confirms if the cash flows are solely payments of principal and profit, fixed deterministic profit past, whereas variable or performance contingent returns without capital protection will fail the SPPI test. For the amortized cost versus fair value, depending on the test results, we split into two models. Amortized cost applies to fixed instruments like ijarah or murabaha, held strictly to collect contractual cash flows, using the effective profit method with no adjustments for market price movements. Conversely, variable structures like mudarabah or musyarakah fall under fair value, requiring mark-to-market valuations at each reporting date where gains or losses are immediately recognized in P&L or equity. Alright, moving to presentation under MFRS 132. classification hinged on contractual terms. A sukuk is classified as a financial liability if there is a contractual non-discretionary obligation to deliver cash, such as fixed rentals and par redemption. For example, sukuk ijarah. In contrast, a perpetual sukuk is classified as equity if it has no fixed maturity and profit distributions are entirely discretionary by passing the P&L as equity dividends. For the statement of financial position and disclosures, on the balance sheet extract, liability classified sukuk are grouped under liabilities at amortized cost, with payouts shown as finance costs. Equity classified perpetual sukuk sit separately under equity. Finally, our disclosure footnote highlights that groups maintain beneficial titles over the asset pools via an SPV, ensuring transparent reporting of the effective profit rates applied. So, in conclusion, the presentation of sukuk under MFRS 132 hinged on the presence of a contractual obligation. Instruments with fixed obligations are classified and presented as financial liabilities, with payouts recognized as finance costs in the P&L. Conversely, perpetual instruments with discretionary payouts are classified directly under equity. Robust disclosures, such as those modeled by Malaysian IFIs, ensure that stakeholders fully understand the underlying SPV structures, asset pools, and effective profit rates.
Moving on to our findings, let's look at how the Malaysian Accounting Standard Board, or MASB, approaches the reporting of sukuk. To align with global frameworks, MASB relies on MFRS 9 determinants. This begins with a rigorous dual assessment, the SPPI test, evaluating solely payments of principal and interest, and an analysis of the entity's business model. The balance and classification. But what makes Islamic finance unique is how MASB balances Sharia contracts, such as ijarah, murabahah, or mudarabah, with the underlying economic substance. Depending on how these factors interact, sukuk generally fall into two reporting pathways. Path A, plain vanilla sukuk, which mimic traditional debt structures, are accounted for at amortized cost. Path B, more complex, hybrid, or loss-sharing sukuk are treated using value accounting. Ultimately, this dual focus ensures three key takeaways: absolute comparability with conventional instruments, financial transparency, and global credibility across international markets. The strategic impact. This brings us to our conclusion. The MASB approach successfully closes the gap between international auditing expectations and specialized Islamic contract mechanics by prioritizing a substance-based reporting framework rather than a purely legalistic one. The resulting financial statements become clear, transparent, and highly interpretable to global investors who might completely lack familiarity with Islamic jurisprudence. Striking this delicate balance between Sharia compliance and robust accounting standards is more than just a regulatory achievement. It serves as a cornerstone in upholding Malaysia's reputation as an undisputed world leader in Islamic financial innovation.
Okay, next, my name is Muhammad Amirul, so I will talk about the recommendation. So, the recommendation is the first one, we enhance the Sharia disclosure by mandate the detailed note in financial statement that will explain the specific Sharia contract, asset operation, and also risk-sharing mechanism. This is necessary because the MFRS 9 often obscure this detail by treating asset-based sukuk merely as standard financing liabilities. So the second one is develop a bridge framework for reporting, like Bank Negara Malaysia (BNM) and also the Malaysian Accounting Standard Board (MASB) should create a parallel reporting guideline because they will bridge the gap between the cash flow focus of MFRS and the asset ownership focus of global Islamic benchmark. So, The third one is the standardized the SPPP test, which is regulators need to provide clear decision matrix and the benchmark for the solid payment of principal and profits, SPPP test. And because this will help the accountant objectively classify complex and hybrid suku into amortized cost or fair value model by eliminating reporting inconsistency. And the last one, which is we invest in cross-disciplinary training. Like university like UniKL and professional bodies should develop blended course combining financial reporting and Sharia jurisprudence, upskilling accountants and auditors to understand how complex standard like MFRS 9 and 15 interact is essential for managing new capital market innovation. So that's all. Thank you.